Emma Chamberlain is raising $10 million for her Chamberlain coffee brand. And as luck would have it, someone leaked their 2024 deck that kind of like walks through the brand narrative, some of the metrics, and tells us a story that they're telling to the investors to justify that amount of money. In today's video, I want to take a look, walk you through the process of what sometimes goes into some of these presentations and what kind of information they mention there and why. So I'm going to take you through it based on my experience coming from private equity and venture capital. And we will take a little bit of a skeptical look at all the information that they present because I want you to understand the pros and cons of certain data points or things that they mention. So let's just jump straight into it. First and foremost, worth calling out is that this is based on the Business Insider article. Not all slides were included, at least in the version that I got. So there's probably some content that's a little bit more private that they decided to exclude to avoid kind of like, catching a lawsuit from the Chamberlain coffee. But a lot of the information is here, and a lot of key information that I would want you to be aware of is here, which is kind of like why we're here for. First and foremost, one of the first slides, and it's slide 10 in their presentation. And by the way, apologies for the quality. That's the quality that they've provided. So, we're dealing with what we have. But the idea is that you always kind of like start these conversations from the TAM, total addressable market. You want to tell the story to the investor who might not be familiar with the industry, because in some cases you'll be presenting to someone who is very familiar, say with this case, coffee business, but it could be just an investor who has the capital to deploy, but they need to be convinced. And you start that convincing by painting the picture of the overall kind of like industry and where we stand. And here are the key data points that they're trying to bring to the table, which also informs some information we'll see down the line, is that they're calling out the total market that they're facing today, roughly what it looks like 30 with the quality, it's hard to tell. It's 351 billion, which is a lot. I would more expect to be 35 billion, but let's roll with it for the sake of being, it's 35 something basically. But yeah, no, it looks like 35, 351 billion dollar market. The key items that they call out when they talk about the market is really kind of like the growth in the roast coffee, coffee RTD, which stands for ready to drink, and matcha. You will notice that those are the key three areas that they keep coming back to, which is absolutely normal. If you go and like look at the Chamberlain's coffee website, they are selling the roasted coffee. So like whether it's a beans or a grind, they do sell ready to drink drinks. So it's basically anything that comes in a can. And then they also start selling matcha, and there's some things that they're announcing for 2025 in this deck. So you can kind of like already tell that they're starting to like leave the breadcrumbs from the narrative that they're going to follow. And the other part of it is Gen Z market, which you again will see as a recurring basis through the rest of the deck, that they're talking about the size of the Gen Z market and how big it is compared within that overall global coffee market. A few key, again, data points that they're calling out is really just the fact that how Gen Zs are more interested in the ready to drink drinks. So that kind of like already tells you, if you're seeing this, it's like, okay, I expect that they will start talking about how the future growth of this brand depends on the ready to drink drinks, which is exactly the case here. But again, no content on the deck will be mentioned unless there's some narrative tied to it, which again is a good storytelling, right? If you're a creator and you think about it, you don't want to put the point, like story point bits in your video if it doesn't have some sort of payoff. And in this case, they're kind of like landing the payoff, like, hey, Gen Z is a growing market, ready to drink category is growing, and by the way, Gen Zs love this category, so it's gonna grow even further, right? Cold brews, again, it's probably like right there in the bucket of future growth for the Gen Z. And then the flavored coffees, again, mentioning that Gen Zs love flavored coffees, and this is why we're emphasizing this. So the stage is set. With this slide, you kind of set the stage. Here's the growth of the market. And these big numbers, sometimes they get exaggerated in this kind of content because you want to show the highest number possible, because your valuation and some of the future growth potential will be based off of this number, right? No one assumes that you're going to corner the entire market, but you're kind of like building a narrative like, hey, if only I'm going to get 1% of this market, it's going to be a $3 billion business, right? So that's kind of like the idea of this kind of content. And then they talk a little bit about Gen Z preferences. Again, as you can see, the narrative is built around the Gen Zs. That's who Emma Chamberlain kind of like has the strongest loyalty and brand awareness with. And that's what they talk about. They talk about the brand awareness compared to some of the other coffee brands. They talk about the customer conversion, and they talk about social engagement. Again, social engagement is a little bit cooked, in my opinion, as a metric. because yes, it's so exaggerated compared to the other brands, but also because Emma Chamberlain is front and center of all that social engagement, right? Predominantly, at least. So they kind of like get a little bit of a boost here. But again, I usually look at this kind of content as a way to say, and even here, it's a study that they work with UTA. It's interesting. It can be an interesting data point, but also I usually have a lot of questions about the form of the study, the science behind it, what was the sample size, things of that nature. So I kind of want to be a little bit critical because me as a company that raises the funds, I'm going to pick the study that helps me support my narrative, right? So as an investor, you kind of take a skeptical look at like, hey, are they really experiencing all of this, or it was like very well cherry-picked set of data? So again, probably okay. I don't see anything necessarily super controversial here, but something you always want to be thoughtful of, that investors have seen plenty of this. So if you're pitching your brand to an investor and you're trying to show them this kind of data, just assume there's going to be a lot of healthy skepticism around it. They talk a little bit about the transition to omnichannel, which is also interesting because a lot of their growth narrative, I'm kind of like spoiling the future, but a lot of their growth narrative comes back to the retail. And this is kind of like the slide again that sets the story beat of that stage, that's saying, hey, at the very beginning in this like Chamberlain 1.0 between 2020 and 2023, we were really focused on the online sales, which is the case. That's why they've been driving predominantly, right, like through the Chamberlain Coffee website sales. But for the past couple of years, they really focused on expanding into omnichannel, meaning multiple different channels, right? They have their online retail, but then they have store partners, and the store partners have physical locations, and they also have digital locations, so you can buy it in multiple different places. And again, it comes back to the fact that Gen Z's kind of like, they say it a lot, hey, meet them where they are, which is kind of like a standard thing that you will hear anyone say. It's like, meet your customer where they are. Smart strategy. You should always do that. So this is again story beat that they're kind of like setting the stage, like, hey, this is where the growth's coming from. It's not online only. We have to be an omni-channel company. Talk a little bit about the retail enthusiasm, right? And in this case, it's very interesting because the sheer amount of quote unquote doors that they're selling at, what it really shows you the crazy growth in terms of like the amount of places that they're selling Chamberlain coffee at. And each number represents number of doors, meaning number of stores. So for example, if you sell it through Target and Target opened up Chamberlain coffee to be in stock at like 1,000 locations, it's 1,000 doors, right? And this is pretty like significant stat. If we're just looking at the first half of 2024, they reached 55,000 doors, which is quite impressive, right? Again, Costco being one of the big key partners for them for the rest of 2024, which I've been to Costco enough of times, including yesterday, and I don't recall seeing Chamberlain coffee, so they yet to stock it, right? It's probably 2025 impact where we're going to see it the most, but it's impressive. It's still impressive to say that from the online only brand, they now have north of 55,000 potential stores, and stores can be very small venues. It also can be kind of like, just like a shelf in a gas station, but it also can be like a major stand in, say, a Target, right? So your mileage may vary per this stat, but it's still impressive that they've been successful at growing their retail strategy. Skeptical look at this, one of those things that I don't see is how many of them, they kind of like mention new accounts versus extension versus existing pods. I would love to see also the stat on the churn, like was there any churn? Were there any locations that stopped selling Chamberlain coffee? Because it's going to be important to dig into as an investor and say, okay, how many stores did you actually lost? Because I won't believe that it's still everywhere, right? There probably were some towns, some cities, some places where they realized they cannot move this inventory and they stopped buying it for that specific location. Why, right? There are probably some demographic aspects. There are probably some aspects in terms of like just like supply chain perspective. Maybe it's not as efficient to deliver it there. So there can be some interesting insights for me as an investor about the limitations of the business based on those kind of metrics. But obviously, as you're raising the funds, you're not necessarily going to call it out. Again, I would say you should. As a good brand, you want to be very transparent with your investor, but maybe that's something that comes down the line as they kind of like deepen the relationship and they actually confirm this interest from the investor. Now we're kind of like moving into, again, more of retail highlights. As you can see, as I told you earlier in the presentation, they're kind of like driving the narrative of like the retail is the future. And again, some interesting stats in terms of like how many items that they're basically selling within different locations and compared to some of their closest competitors, and giving them some stats about like the interest in the Walmarts, Albertsons, Whole Foods of the world, right? In terms of especially ready to drink. Again, as I said, you notice how like those breadcrumbs start kind of like bearing fruits through the rest of the presentation. They started talking about ready to drink and the retail, and you now start seeing kind of like the narrative intercombining. Nothing necessarily groundbreaking. It's interesting, but not necessarily something I would take into account too much as a um, investor at this stage. There's some other metrics that I would love to see first. There's some interesting learnings, which again talk about a little bit limitations. This is where they touch on some of the limitations of the business, right? Like retail optimization, because again, that's one of the challenges with whenever you deal with brands, and I've kind of managed operations and managed finance for a couple of retail brands. There's a lot of work, right? Like you don't imagine the complexity of, for example, making sure if say Target decides to sell your product, that's amazing news for the brand. It's like, oh my god, I'm in Target now, oh my god, I'm in Whole Foods now. But in reality, it is a lot of pressure now because there's minimum purchase amounts, there's minimum number of pallets, for example, you need to deliver to each location. In many cases, if it's a professional enough Trader Joe's of the world, right, like a business brand, they usually have a distribution partner like UNFI who you can go bring the products to, and UNFI will go and make sure it's on trucks to the right locations, right? But you still need to deliver very set specific amount of that inventory to a very specific location so they can go and distribute it, which is a lot of money and upfront investment. And that's why retail optimization, understanding where do we deliver, how quickly do we deliver, how quickly do we make sure they restock so that the restocks arrive in stores on time, because if we miss a restock window, there's going to be unhappy seller, or I guess buyer in this case, they're going to be unhappy buyer at the retail location, because each manager, store manager within those chains are responsible for the revenue of that store. And if they say hope and a certain number of revenue coming from your product and you miss the restock window and now they don't have your product in stock, that's a lost revenue for them. That means that that's a ding on their own performance, which might impact your relationship with that store, or potentially with the number of managers across those stores who'll be like, hey, this is a great brand, but I don't want to stock it and allocate shelf space for it because they don't deliver on time. And if they don't deliver on time, I lose money, right? So that's why it's there's a ton of pressure when it comes to dealing with the stores, and you really want to make sure you get your operations buttoned down if you're want to go play with the big boys, so to speak, and go to the Targets of the world and Whole Foods of the world. And that's where kind of supply chain retail optimization, supply chain efficiency are the big thing, and margin improvement, which again we'll talk a little bit about down the line. But there's this very interesting tidbit of information that they mentioned, that they're aiming to be operationally profitable in 2026. So everything numbers that you'll see, especially we're going to get to sales soon, all of it is still losing money to the Chamberlain coffee, right? So they're still burning through money. And that's part of the reason why they're raising funds. So one of those things that they're aiming to do is actually become operationally profitable by 2026, which again is just interesting bit of information. And as I said, at least it showcases some of the limitations and some of the things that probably will come up during the discussion with the investor. Now we're moving to fun part. So this is actual revenue numbers for Chamberlain Coffee. And again, when you see F, it means forecast, right? So forecasted numbers. But even up until 2023, $19 million. This is how much Chamberlain Coffee made in 2023, with a forecast year end to be at 22 million, and then essentially forecasting to grow up to $33 million in revenue in 2025. Impressive, right? Impressive numbers all through and through, considering especially the growth of quadrupling, I guess 50+%, and then again almost doubling from there on out. A little bit of the stagnation 2023 to 2024, which they call out, and they kind of talk about the fact that they've had some issues with the supply chain, and this is where you see it comes in. So the reason why they only grew a couple of million of dollars between the 2023 and 2024 was primarily attributed to the fact that they actually had issues with producing the product and delivering it to the locations. So they lost the revenue. Coming back to my point about optimization of the supply chain, it's critical. If you're dealing with a physical product, especially if you deal with a physical product that has to be at the retail locations, God bless you. It's a lot of hard work. That's why you need professionals, you need special distribution companies to partner with you, because trying to tackle it on your own is bar impossible these days with the number of retail locations, especially when you sell to 55,000 different locations, right? So it's a little bit of work, and as you see, there was a hiccup, and so they're attributing it to the stagnation and growth. Also, actually, I should come back so you can see my face, so you mean I'm real about it. I'm skeptical. So, in my experience, whenever something happens negative like this, quite frequently it's being used as kind of an excuse, carpet excuse for everything, right? You kind of sweep everything under the rug in terms of underperformance, because yes, it could be that they ran out of stock and it was one of the challenges. But we're also talking about 2023, 2024, when from the financial perspective, There've been a couple of other coffee brands that completely went out of business because of the rising coffee costs. So they can be just the fact that they didn't want to buy, couldn't afford to buy coffee at certain prices. So they actually just halted the production on purpose and they blamed operational inefficiency on that, where in reality it was a business decision. It could also be like a little bit of a stagnation in the interest in the brand, right? And this is where kind of like they're trying to raise the funds and juice the brand, so to speak, to make sure that they can take it to the next level. Because one of the other downsides, when you see these numbers, it can be exciting. And we already spoke about the fact that they're not really making any profit off of this business. So it costs them a lot of money. And when you deal with the inventory, because what I mentioned to you, when you deal with some of those stores, they require X number of inventory to be bought and delivered to their locations. You usually spend millions of dollars in working capital, what it's called, into the inventory so that you have across all those locations. So by the time you're done kind of like buying inventory, you might not have much money to do the actual marketing of your product, which is always this careful balance for the retail brands between having to promote it, and the more you promote it, the more there's a demand, the more inventory you need, which means you need to invest in more inventory, which means you potentially have less money to spend on marketing. So it's this like interesting loop that's happening between those three metrics. And I suspect it wasn't just about inventory. There were some other things happening. And the reason why they kind of like, went from growing at like 400% to 50% to now pretty much growing. It's still decent clip. It's like still double digit growth, but maybe not as close as they're supposed to be. And the other part that I'm also very curious about, they're obviously talking about and kind of like, having to uh, leverage the Gen Zs, the ready to drink drinks, and they're expecting to grow at like 50% to $33 million. I would love to see the financial model behind those assumptions. If I'm an investor, I would want to see your assumptions in this growth, because this is quite significantly, especially after the hiccup of 2023 to 2024. And again, it was a forecasted number, so who knows, maybe the final number even came back closer to 19 million, right? So I have some questions when I see this $33 million number in terms of what are your assumptions behind this and how are you getting to it with the money that you currently have, right? And do you have to have this fundraise, which I suspect you do? And if you do, then I have some questions for how you're investing in it, which they cover in one of the future slides. But again, great number. Have a lot of questions for it as a potential investor. And again, coming back to the whole point about always being narrative driven, since they spoke about the fact that they have that issue between 2023 and 2024 with the supply chain, they're talking about the fact that they now have new suppliers, right? And they have a dry co-packer, which is essentially covers what I suspect, right? They're essentially coffee beans themselves, grinds, single serves, things of that nature. And the fact that they're supplying, Starbucks and Peet's Coffee, so pretty large brands, and supposedly they will have the facilities and the capacity to handle it. And ready to drink co-packer that also supplies, massive brands that you can find probably in your local retail store. And so that's another part of their story, that hey, now we have partners for that. Again, good to know. You always want to have this kind of explanation. If especially in the prior slide you're calling out the fact that you had issues with the retail, my next question is, what are you doing about that issue? And so they're kind of addressing it. So that's the whole purpose of this slide, in my opinion, is that it's really not to tout themselves being like, hey, we have great suppliers. It's more like, hey, we have a problem. Here's the issue with that, a problem that was behind that problem, so to speak, and this is how we're solving it. So this is the entire narrative basically between those slides. Retail growth is interesting because now we're looking at especially forecasted numbers, and I'll flip between the slides to kind of like tell you a little bit what I've observed, right? As you can see, it's like 2020, they made $0 in retail and $2 million overall. So basically all this $2.6 million in revenue came from Chamberlain Coffee website, which also makes sense. They're at that point basically sitting on the in the pandemic, sitting at home selling the coffee. So I wouldn't expect too much of revenue from the retail locations, right? So basically at that point, then it grows again to the 874K. So just a little bit, and then continue to go from there. The percentages kind of like tell you this interesting story, right? Where, as you can see, it starts to increase, where it starts at 11% as they start opening doors, right? More doors, so to speak, and expanding into more locations. So they have this spike, and now 34% of their total revenue sits in the retail. Again, right? The original number was basically around 19 million, but it also echoes back to these locations, because then you start kind of like seeing through 2023 this spike in the number of retail locations that they're selling through. So this is now can be all tied together. You have the spike, and as you see kind of like the spike through 2023 and 2024, you see kind of like the revenue picking up, obviously with this hiccup over here. And then you can see that as a percentage by 2024, it's over 50% now of their total revenue, and they're forecasting it to be north of 60% come future. Again, it can be a good or a bad plan, right? We don't know that. That's a decision for the investor to make and for the brand as they kind of like strategizing around it. But I'm just showing you that how this all narratively starts tying together, right? Like you want to make sure those ties are happening in your presentation. The worst thing you can do is present information or data points that contradict each other, because then you're just confusing the messaging. And as an investor, I have a question for you. Like, do you even understand your own brand to handle it? And here, clearly you do. You understand the narratives. You've been driving the narrative around the retail, that's your future to growth. And you're telling me that you're going to also grow it as a percentage share of your total revenue. So kind of like narratively is a nice story. And again, I don't disagree. I think for the beverages, it makes sense that retail will be a big point of sale, especially for people who are like, buying lunches, or like say they're just doing their regular grocery shopping and want to have like those ready to drink drinks available at their house or their office. And before I flip to the next slide, speaking of narratives, remember that whole call out about matcha and Gen Zs? And it's like, why are they talking about matcha Gen Z and why they're talking about the flavored drinks? Well, this is where this point starts echoing the flap of the butterfly's wings starts to echo. They talk about the matcha gross sales. So they basically talk about the fact that they started to sell some versions of it back in the day, made about 300K in 2021, 1.2 million in 2022, closer to 4 in 2023. And now they're launching ready to drink product with matcha specifically in 2025. And again, you see some market size. They spoke about this 12% CAGR growth, right? So think of it as growth, just like cumulative aggregated growth. But just again, 12% of growth, that's the easiest way to think about it anytime you see CAGR. From the perspective of the total market, they're basically now coming back to that narrative of, hey, we had just a couple of lines, it was just coffee, but by the way, this matcha market is growing fast, and by the way, Gen Zs really love it, and we're kings of Gen Zs, and kind of like they really love what we're doing. So here's all of this coming together and saying, not only we're gonna raise the retail market and we're gonna raise it as a percentage of our total revenue, but by the way, we're gonna have this matcha drink that's gonna really help us take off. Ton of questions about that, specifically because this is where I can very comfortably put myself in the shoes of the investor who has zero clue about the market, because I have questions about the potential for the matcha, right? Like I would want to see how's it growing for the other brands? Do we see the similar kind of like spikes across other brands? What is their growth? Are they taking advantage of the 12% growth in the marketplace? Is there something else happening? What is the social media is telling us and the data from there about the impressions? Because to me, and again, what do I know? It seems like it's more of a passing thing, that I don't necessarily think matcha will get stuck, because like again, cold brew stuck back in the day. There were some frappes, frappuccinos, mochachinos, all that kind of stuff that's happening. Feels like comes and goes, comes and goes. It's like your pumpkin spice lattes of the world. Like can be very seasonal. Again, can still drive a ton of revenue for you, but this is where I would want to see some additional metrics besides just, hey, by the way, we're going into this space, right? But again, it's interesting to see that this is kind of like what they're banking on. It's what they want to invest in. They think that the Gen Z market share is coming from their 1.1 billion market share is pretty good. And assuming, again, all the engagement metrics, right, that they've shown earlier or here, they can start saying like, hey, we're one of the leaders here. And we're going to go and essentially, because of how much of the awareness is, technically, if it's a $1 billion market for matcha and our awareness is 40% or 50% brand awareness, it's almost 50%. So we have a potential of $500 million of revenue just from matcha market alone, right? Ton of assumptions behind it, but that's kind of like the narrative you want to tell the investor to get them interested in investing in your brand. And then they talk a little bit about the physical locations. I had some beef in the past with this idea, but hey, always open to be proven wrong. And it's actually, there's something here that came up that made a lot more sense to me why they would do it. But basically, they're talking a little bit about the direct-to-consumer location. I'm forgetting the name of the mall, but basically they opened in one of the, I think, LA malls, where it's this kind of like a small location. It's not a major like a Starbucks store. They're not like leasing the entire space for like several years. They just have a small kind of like, you know, bigger than those like mall carts that you sometimes find that's selling some sort of like silly knickknacks or like printing t-shirts, but big enough to kind of like sell the product, but also promote some of the products and have like a spot of the engagement with the consumer. I have many opinions, mostly negative ones, about the future of the malls, right? I don't think it's going far. I'm not sure how big of a play this is, but some people do think that actually malls will be coming back and it's going to be the place for social engagement, but it's just going to be more experiential, less kind of like shopping style. So for that, having a coffee stand like this can actually make a ton of sense, especially if those are the areas that are heavily populated with your target demographic, Gen Zs in this case. So from that perspective, again, open to be proven wrong with this strategy, but usually I have some opinions, especially when it comes to like the complexity of execution. And this is where I'm kind of like seeing the vision a little bit, in the sense that when they talk about the capex, there's actually no capex, meaning capital expenditures, right? There's no investment that Chamberlain Coffee itself is making to open these locations. There's actually a JV partner, which is joint venture partner with this, and they are the ones who are investing in the first 5 cafes, which tells me that they have a investor slash partner who said, hey, they're probably coming from the space where they have similar kind of locations for other brands, and they said, we know what we're doing, we know how to stand up this kind of location, we're going to pay for everything. And so they're basically paying for those first 5 locations to test the market. And it seems like, again, pretty decent growth, 1.8 million in revenue from the first cafe and 17% EBITDA margin. So they basically make like what, 120, 1/5 of this, right? So 240, no, yeah. It's like 350 or so, right? Around 40%, 340K that they made in EBITDA, basically in almost a profit. Again, depends on some of the metrics that they have there off of this location. So now the idea behind having a joint venture partner is that they'll take you on the risk right now in advance, but I fully suspect that they're going to own the biggest share of those retail locations and the sales if this play works out, right? They'll very likely require Chamberlain Coffee to go co-invest with them in the future locations, and then they're going to own a bigger percentage of that. So, which is not unusual. There are plenty of brands. If you've never heard about this before, there are plenty of brands, although you might say buy from them the same type of, like, in this case, coffee, right? The coffee in a store, the coffee in online retail shop that they own, and the physical location, but it can actually be 3 different companies behind each. So the brand is the same, but there's one company that co-invests and co-owns the entire retail space, right? Because they might have great distributor partnerships. They can have a relationship in some of those like Targets, Whole Foods of the world, and they can also know how and when and how to supply, to invest, and they take on a portion of the risk, right? So as a brand, you can say, hey, I'm going to spin out portion of my company, and this is going to be just for the retail locations of other stores, and there's going to be joint venture partnership, and it's going to be separate entity, and it's going to be co-owned by my Chamberlain brand. So that's one. Then I have my Chamberlain primary brand, and I sell online. So this I own it maybe 100%, or maybe again I have a joint venture partner who knows how to run a website and run a promotion, and I can even give them a portion of the business, and it's a second company co-owned by my parent brand. And then you can say, hey, and by the way, if I'm going to physical locations, I'm opening the store, I'm actually doing it by creating a joint venture partnership, and now there's another venture partner who actually knows how to run the retail locations, and they're going to do the hiring, the firing, they're going to take care of all the like kind of like logistics of actually managing the retail location, finding the right spot, doing all that market research. I'll just go on a percentage share of that, and maybe even a very small percentage of it at that, right? We're just going to slap my name on it. So all of a sudden, instead of one big company that you think exists as a Chamberlain Coffee, you can have 3 other companies completely separate, co-owned by this master brand, but other ownership can be completely unrelated to each other. So again, it's all your complexities from the corporate world, but it might make a lot of sense. And the whole point usually of this movement is co-find the investment and the investment into something like this, right? When you go and pursue investment through this kind of like deck that we're reviewing, you usually offer the top line, right? So you have your main brand, Chamberlain Coffee, and you have to kind of like give out the percentage of that brand. But when you do joint venture partnership, you agree only on the percentage ownership of that joint venture. So that partner rarely owns the percentage of your overall company. They just own the percentage of the venture. So if that, for example, say this physical locations completely fail, you only lose the equity off of that part of the brand. Like your brand itself remains the same unless they negotiated somehow part of that equity of the primary brand. But this is a way for you to find co-investor, find someone who helps you potentially manage with a better experience, right? Have an expertise in that space. So that's the other reason why you would take them. And the third reason, just de-risking the business. Sometimes it makes sense when you spread yourself too thin to say, I'm going to de-risk myself by splitting my company into 3 different companies and offer co-ownerships of each company, so that then I can kind of like have a more stable footing because they're experts and know what they're doing. They have their own money that they co-invest with me, and I have less risk overall in my business, right? So because of this, makes now a lot more sense to me and why they would try this, especially when someone comes in and says, hey, I'm going to pay in full for the first 5 locations. Makes all the sense in the world. First time when I heard it, I was like, do you really want to go there, especially if you don't have experience in it? Clearly they do. So good on them. And finally, for the last couple of visuals, they talk about their team. Not going to spend too much time on it. Again, if you're curious, you can go and LinkedIn those folks and see who they are. That's all nice and fine for me. The only reason I wanted to call out this one from the skeptical perspective, companies love doing this. They love calling out, like, here's the industry experience for our team. And in this case, it's like McKinsey & Company, which is like one of the big consulting companies. EY, again, one of the big consulting companies and auditors. Vital Proteins, for Sigmatic, Forbes Under 30, blah, 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 blah. My skeptical look usually at this kind of things is that you never know the amount of experience. Like, you can put and say, like, hey, I'm ex-Google, ex-Facebook, ex-McKinsey, whatever. And you spend 6 months, and like 8 months in each of these companies, right? Like, did you really take on the full experience? Again, can be different. That's why it's always interesting to go actually look those people up and see what their true experience is like, because you can call yourself X whatever company, and it's going to look nice on this kind of presentation that, hey, you have people coming from McKinsey, but then they might have spent only a few months in there, and that's really about it. And so they're just using it for kind of like their own brand awareness. So again, just a small tidbit of information for you whenever you see in the future something like this. Just be skeptical in terms of what was the real experience and was it even relevant to this. They could have been at McKinsey, but they were, I don't know, assistant to an executive, right? So how much of actual operating experience they had, or role in the experience in the role that they're currently taking on. So that's my small point. And investors usually want to call those out, and it's a good thing to have because it gives you a little bit of credibility in terms of, hey, if I'm presenting to you as an investor, right, I'm telling you, here's all the other investment shops that co-invested already. And it can give you some confidence. For example, if you see someone like Google Ventures or Anderson Horowitz, right, like those big guys, big venture players in Churning Group, right, like you can look at it and say, like, yeah, okay, if they're co-invested here already, me putting my money here basically means that I'm making the same kind of decision as the others. And it's also important for investor themselves, because don't forget, in some cases, investor can make their own decisions, especially if it's their own money. But if you're representing like a venture capital company, you usually have investment committees, ICs, and you have to go back and present to them and say, like, here's why I think it's worth for us to invest in this company. And it's a little bit easier for them to go and sell that idea, if especially they're really sold on it, by showing also this list of investors and saying, hey, here's all the amazing investors. And also that's part of the reason why you have the operational team like this highlighted, because you also can point and say, and here are all these amazing smart people that are working at this company, so we know we're making a safe bet. So whole point of this presentation usually trying to explain to the person why it's a safe bet to invest in their brand. And another one, which is kind of like always interesting to talk about for these kind of like startups, is that all the investors are seeking exit, right? Meaning they want to have some sort of liquidity event, what is called, where either the company goes public, right, IPO, or the company is being acquired by another company so they can extract the cash back, because this is ultimately the performance measure for the investor. What is their return on the money that they've invested? And here they kind of like call out and say, like, hey, here's some of the comparable acquisitions that happened in the past. Blue Bottle got acquired by Nestle for $625 million. Costa was acquired by Coca-Cola for almost $5 billion. Lacombe was acquired by Chobani for almost $1 billion, and Caribou was licensed by these two. Interesting data set, but I guess maybe there's some path for them to be licensed by another co-brand, and who knows, maybe like partner with Starbucks out of all the worlds, right? And they kind of like mentioned the fact that they've had some interesting conversations with, these are major, right? Like Coca-Cola, PepsiCo, General Mills, Nestle, Kraft Heinz, AB InBev. Those are your like creme de la creme of the consumer package world, right? And they do some kind of like very tiny disclaimer over here, which I like zoomed in and read. Basically like, hey, we're really mentioning it, but the series of these engagements is like open to interpretation. two reasons why they do this. So like if you ever see this and you explain like, hey, why should I be putting this? One, as I mentioned, you're talking about the exit, right? You want to explain your potential investor, hey, we have a very strong opportunity to exit this business in the near future. The other part of it is really behind the fact that, hey, we are kind of like talking to all of these companies, they're providing interest. You always want to be skeptical about it, primarily because interest can be just a conversation. All companies talk to other companies about potentially either acquiring or being acquired. That's normal part. The function is called corporate development, usually in the corporate world. CD teams, so corporate development teams, that's the entire job. Constantly talking to other CD teams about like, hey, would you be interested in acquiring us? Would you be interested in selling to us? Always happens. So whenever you're working for one of those companies and you hear like, oh, we're potentially getting acquired because we're talking to this company, not really. Unless someone signed like an actual letter of intent and there's actual due diligence, the data rooms are being opened and the data is placed in the data rooms. All this stuff I can explain in future videos. It's not really happening. Conversations happen all the time. So you quite frequently hear rumors about like, oh, this company is about to be acquired by this company because they're talking to each other. Doesn't matter. If they're just talking to each other, it doesn't really matter because ultimately everyone talks to everyone all the time. That's part of their job. And finally, kind of like the cool call out before I make this video way too long, is the fact that the total number that they're raising $5 to $10 million. And this is kind of like the breakdown that they're telling us. They're telling us that they can invest in OPEX. So basically just again, investing into the team, right? Like retaining and developing team, which they say, right? Which is interesting. Probably some retention bonuses that's going to fly around. Working capital. So again, inventory, as I mentioned to you, you're in a retail space, inventory is a huge thing for you. So that's something they want to go and invest basically 30% of that. And then promotional spend, marketing. So as I mentioned earlier, it seems like I think that like slowdown between 2023 2024 was not only related to supply chain issues. So part of the reason why I think they're going to be investing so much money in the promotion, because they now built a strategy. They said, hey, ready to drink is growing, matcha is growing. We're going to have matcha ready to drink and Gen Z love it. And we have big Gen Z awareness. So we're going to just push that messaging out there, right? So this is their bet basically. And this is where the money is going to go. And you kind of can see this talking in these kind of key initiatives, right? Like strengthening the Gen Z consumer relationship, building up on retail momentum, again, turning on the opportunities in matcha. Again, matcha is right there. And talking about profitability, but again, they're not really focusing on getting to profitability until 2026, right? From one of the visuals that we've seen before. So from that perspective, it's kind of like 2025 seems to be the year when they really want to kind of like raise this 5 to 10 million, invest some in inventory, probably to build out those ready to drinks, especially the matcha, continue to push in the retail, and then use the promotional budget and spend, right, basically almost half of that budget that they're raising purely on the promoting and kind of like throwing the brand name out there so that they can hit that, what it was, like $33 million, right, in total revenue. I'm already forgetting. Hold on. Yeah, $33.4 million in revenue that they want to hit. And once they're kind of like there, they'll be, okay, now we're ready to turn profitable essentially to ensure that we show operational excellence. Because one of those things that I've also did some research on, I wanted to look at what were actually the metrics behind each acquisition that they mentioned. And the only real metrics that are shared are around the Costa Coffee being acquired by Coca-Cola and the multiples. Again, I've made videos before about multiples, so like look up my videos about the acquisitions and kind of like selling brands. But basically, the multiple on EBITDA is about 16x what Coca-Cola paid for Costa. So right now, Chamberlain Coffee is negative EBITDA, so they're not making any money. So they need to turn this number profitable before they can even entertain being potential target acquisition at purely EBITDA multiples, right? There can be some talks and there can be some interest from them acquiring parties to acquire Chamberlain Coffee because of the brand and the popularity. And then you kind of like worry about, as a bigger company acquiring a small company like this, you can say it's okay for me to acquire a non-profitable company because I can turn them profitable since I have all the supply chain, I have all the expertise, I can turn them profitable very quickly, but they'll have the brand recognition that I like. So they'll still have opportunities to sell the company, but from the perspective of the return on the investment and real money that they want to make, the real money really comes when you show that you're actually profitable. So I hope this was useful. This was a lot of content. I'm like looking at the timer and we're like north of 30 minutes. I think it's going to be officially my longest video, but I hope you found it useful, this kind of like walkthrough through the entire deck and the reason why they talk about it. And I think the key takeaways for all of you should be how you build the narratives, right? Like as you see, narratives that you said at the very beginning of this kind of presentation take you all the way through the end, and they all have to jive together. Calling out some of the negatives, always important to show like, hey, if there's some bumps, there's some inefficiencies, call them out, make sure you have explanation for them. There's a dedicated slide for explanation that they're giving for one of those downturns. And then just ensure you're being very transparent and you show the future, you show that potential and how the money that you're going to raise will ensure you double, triple that business. So again, hope this was useful. I'll try to kind of like, again, hang around in the comment section. Obviously, as always, if you have any questions, let me know. If you want to talk about any other brands, or you want to kind of like, potentially evaluate how you would present your brand as you're trying to raise money, reach out. I'm on socials as TohirT everywhere, so easy to find. And in the next video in the series, I'm actually going to talk a little bit about how you would build that narrative from scratch and some of the key things that you would want to call out if you're doing this for your career brand. So subscribe, stay tuned, and I'll see you next Saturday. Peace.